Imagine if you had indicators that don't just react after the move, but actually give you a heads up before it happens. Reversals, breakouts, even those sneaky smart money shifts that catch most traders off guard. That's the promise of the 3 TradingView indicators I'm about to show you. Some traders even call them the closest thing to a crystal ball. Stick with me till the end, because I'll also show you how to combine them into real trading strategies with stop losses and take profits. And we'll even walk through live examples so you can see exactly how they work in practice. So I am in TradingView. Let's add the first indicator to our trading chart. So open the Indicators tab from here and search for Harmonic Patterns plus Fib. After that, add this one to the trading chart. Don't let the fancy name scare you. It sounds complicated, but when you see it in action, it's actually very straightforward. You can use it on any market or time frame you like. This tool is like a pattern scanner that hunts for geometric shapes such as butterfly, bat, or Gartley patterns. These have been used for decades by professional traders to anticipate when the market is likely to reverse. The best part is you don't need to draw anything manually. The indicator automatically finds the patterns and then overlays Fibonacci retracement levels on them. These levels act like checkpoints where the price is most likely to react. Here's how you actually trade with it. If the indicator detects a bullish harmonic pattern, you don't just instantly buy. You wait for the price to rise and hit the 0.382 Fibonacci level. That's your buy trigger because historically, bullish harmonics tend to take off right from that zone. And on the other hand, if it detects a bearish harmonic, you wait for the price to dip into the 0.618 level. That's your sell trigger because sellers usually step in hard at that point. Let me give you a clear example. Imagine price has been dropping, and the indicator suddenly prints a bullish harmonic pattern. The price then bounces and touches the 0.382 level. That's where you'd open a buy position. Your stop loss will go under the lowest point of the pattern, and your take profit targets can be set at higher fib levels like 0.5 or 0.786. Often, the market reacts right from that 0.382 and pushes higher, giving you a clean trade. Just like what happened here with our example. Let's go through a sell trade example. So if the price is rising, and the indicator prints a bearish harmonic pattern, just like we can see happened over here, you will wait until the price falls back into the 0.618 level. That's your entry for a sell trade. After that, you can set the stop loss above the pattern's top, and your targets go lower along the fib levels. One trick to increase accuracy is to combine the harmonic trigger with candlestick confirmation. For example, if price touches the 0.382 level in a bullish setup, and you also see a strong bullish engulfing candle, that's double confirmation. It means not only did price hit the key level, but buyers also showed up aggressively. The same works in reverse for bearish trades. This simple filter saves you from jumping into weak setups. Now let's move to the second indicator.
Do you feel like everyone around you benefits from artificial intelligence, but you have no idea where to start? Don't wait any longer. Start today. Our free trading bot is simple to use, powered by artificial intelligence, and can earn you up to 1% profit every single day. Over 500 members have already joined. Click the link below now to get free access. This is your chance to harness the power of AI and take a step toward a financial boost.
The name of the second indicator is Smart Money Trades Pro. This one is built on smart money concepts, which basically means following what the big players are doing. Add it to the trading chart. It automatically marks break of structure, called BOS, and change of character, called CHOCH, directly on your chart. If price breaks above a previous high, you'll see a bullish BOS. If it breaks below a low, you'll see a bearish BOS. A CHOCH happens when the market flips direction, like going from higher highs to suddenly making a lower low. These are extremely important because they often signal that the trend is shifting. Here's why this indicator is so good. It doesn't just mark BOS and CHOCH, it also shows you potential entries, stop-loss levels, and even multiple take-profit targets. It's like having a built-in playbook. Let's run through an example. Here we can see the CHOCH appears, showing that sellers are stepping in. The indicator highlights a sell entry with a stop above the swing high and 3 profit levels below. You can scale out, taking some profit at TP1 and let the rest ride to TP2 or TP3 if momentum continues. On the other hand, if price is falling and then prints a bullish BOS, it's telling you that the downtrend might be ending. You get a buy entry signal, with a stop loss under the swing low and targets above. To make this strategy even stronger, combine the signals with volume. If a BOS forms and you see a spike in trading volume, that's a sign that real money is behind the move. You can also combine it with support and resistance. For example, if a bullish BOS appears right after price bounces from a major demand zone, that's about as high probability as it gets. Another tip is to trade in the direction of the overall trend. If you're in a strong uptrend and keep seeing bullish BOS signals, you can use them to keep joining the trend instead of trying to fight it. Now let's move on to the next and final indicator. The third indicator is called adaptive valuation by Backquant. Think of this one as a market thermometer. Add it to your trading chart. It shows when an asset is undervalued or overvalued and likely to snap back. It uses a mix of RSI, CCI, directional movement, and other oscillators under the hood, but all you see is a smooth line that moves through green and red zones. When the background is green, the market is undervalued. When it's red, it's overvalued. The trick is to not buy just because the background turns green. You wait for the valuation line to curl back up and exit the green zone. That's your buy signal. Same for sells. You don't sell as soon as the background turns red. You wait for the line to roll over and exit the red zone downward. That's your sell signal. Let's say price has been dropping hard. The background flips green, but you wait patiently. Eventually, the line curls up and exits oversold zone. That's your entry for a buy trade. And you can enter a buy trade over here. As you can see, after some time the price rebound, and this would have been a profitable trade. And similarly for a sell trade, if, for example, later after a strong rally, the background flips red, the line stays high for a bit, then rolls over and exits overbought. That's your cue to sell, often catching the top before a correction begins. This tool works beautifully on its own, but it's even better as a filter. For example, if you only take bullish harmonic trades when adaptive valuation shows green, you're stacking the odds in your favor. Or if you only take smart money BOS buys when adaptive valuation is coming out of oversold, you've just added another layer of confirmation. That's how pros build strategies, by combining tools that confirm each other instead of relying on one signal alone. That's the breakdown for today. If you found value in this, hit the like button and subscribe so you don't miss the next one. Drop your thoughts or questions in the comments below, and I'll make sure to answer. Thanks for watching the video till the end, and I'll see you in the next video.